Thank you so much for taking time out of your busy schedules to attend our fourth quarter version of WP90X, 90 minutes of extraordinary education on a topic that is near and dear to my heart and consequently the other two panelists' hearts that are on the call. We're going to go through premium finance unpacked and go through the benefits, pitfalls, and really identify who it's a correct fit for. So my name is Ryan Barradas. Most of you know me. I'm the managing partner of WealthPoint, and I head up our ultra affluent family services practice, and we use premium finance quite a bit. I would say that it's probably about somewhere between 60 and 70% of our practice in working with ultra affluent family groups. I'm also joined by my colleague and our Director of Insurance Solutions, Kim Boston. Kim provides a unique perspective because she's dealing with not only the design and identifying products, but also she manages our service team. So we're managing the in-force portfolio review. And as we say at WealthPoint, life insurance illustrations only prove one thing: paper can hold ink. It's built on a mountain of financial assumptions. And so we have to live with the aftermath of those assumptions. And we'll be working through what that really means. And then Amanda Garcia is the VP of Business Development and is our primary contact at Wintrust. And rather than me butcher a commercial on you or Wintrust, maybe you can share a little bit of insight about Wintrust and the bank's focus on premium finance in general.
Thanks, Ryan, and thanks for having me today. I'll go ahead and butcher that for you. So, as Ryan mentioned, my name's Amanda Garcia. I'm Vice President of the West region of the United States for Wintrust Life Finance. Wintrust Life Finance has been in the premium finance industry for 27 plus years now. We have a team of about 100 people who do this all day, every day. We're really passionate about it. We are part of a bigger bank, Wintrust, which is a top 40 bank in the United States, about 70 billion in assets. Of that, our premium finance portfolio makes up about 18%. So, happy to be here, really passionate about premium finance, love working with Kim, Ryan, and the team, and just excited to talk some premium finance today.
Perfect. It's always good to work with an experienced bank. We've had the unfortunate pleasure of working with folks that aren't so experienced with premium finance, and Wintrust would be the polar opposite of that. So before we get started, we're going to go through and just with some general housekeeping items. We are offering CE or CPE credit for today's program. It's going to be an hour. Please make sure that you answer the polling questions that are going to pop up. There is no right or wrong answer. It's a mechanism that we have to institute in order to make sure that people are actually in attendance. So we can survive our NASBA audit. And again, you're not going to be graded on those answers. If you have a question, please use the Q&A function on your bar at the bottom or the chat function. I'm not seeing my Q&A function at the bottom, so chat function is also okay. Kim will be monitoring those, and we will interrupt where it's appropriate to interrupt if it's something very simple that Kim can answer just by typing it back, but we will share what the question was because it may be a question that somebody asked that other people have the same or similar question, and we want to share that with the group. And if you have any other questions, please message Kim, or I'm sorry, Kristen, our VP of Operations at Kristen@wealthpoint.net. And then if you're interested in getting CPE or CE, you will get a survey after the presentation. We need to have that. Again, that's part of our compliance. And then the CE certificates will be emailed to you within 30 days of us completing the webinar. The general overall learning objectives for this presentation is really to define the ideal clients for premium finance, life insurance, examine the key features of well-structured plans, we're going to spot some frequent errors to avoid, which are usually built in assumptions. One of my favorite lines from old Steven Seagal movie, Under Siege, Dark Territory, is assumption is the mother of all foul-ups. There's a different word other than foul in there, but you get the gist. It really is. I mean, we really need to be able to not only use reasonable assumptions, but then stress test those assumptions to make sure that clients understand the risks inherent in the strategy that they're entering into. And then we'll outline some of the estate and gift tax considerations and understand the proper integration with cash flow, income, and estate tax planning. So before we get started, we'll really start with who it's for. And these are our standards, so we don't want to pretend that these are industry standards, and we have probably higher standards. I would say I would defer to Amanda than most folks. But the first thing is they have to have an insurance need. So we are looking for somebody that has a defined liquidity need, whether it be buy-sell planning, key person coverage, estate liquidity planning, or even sometimes family groups will view insurance as an asset class, an alternative asset class in the overall wealth management and wealth transfer portfolio. But there has to be a defined need, and we'll identify instances where it's sold as free insurance. And even if you don't need the insurance, it's a great investment. Well, there's pitfalls to that too, and we'll review those. But our ideal client for premium finance is generally $100 million in total balance sheet. We go down to as low as 50 million in total net worth. But more importantly, we need to have sufficient liquidity. So we need to have somebody with liquid assets sufficient to collateralize the loan. We don't want this to be just a cheap way to buy insurance, or we need somebody that could pay for the insurance through a cash pay scenario without the premium finance. The other thing that we look for is positive personal net cash flows. So more cash inflows than outflows. We want to make sure, regardless if we're premium financing or cash paying a life insurance portfolio, that this is not something that is unsuitable for the client. They have to have the right risk tolerance. Some people are debt averse and still choose to premium finance because there's a difference between risky debt and strategic debt. And we really view this, if done right, for the right reasons and for the right client, as being strategic debt. And then in terms of age and health qualifications, generally we have people that are below 75 years old. So, as young as you want to go. Generally folks in their 20s all the way up to age 75. I would say 20 to 70 is kind of the sweet spot for premium finance. But we do have some exceptions where we have clients that are above the age of 75 where it works. It just, they're few and far between, and they need to be reasonably healthy. We do premium finance folks with rated health classifications, but in generally just reasonably healthy. It doesn't have to be preferred risk, but we can go through and do a feasibility study for any of your clients if and when it makes sense. So without further ado, I'm going to turn it over to Kim to go through the overview of how it works. And I'm sure Amanda is probably going to weigh in here as well.
Yeah, thanks, Ryan. We thought it would be prudent to set the stage and give a quick overview of a standard or typical premium finance arrangement and structure and how it works, just so we're all speaking the same language during our time together. So premium finance is an arrangement where all or a portion of the life insurance premiums are funded or borrowed by the bank. Okay, so in a WealthPoint typical arrangement, we use a new or an existing ILIT that is the owner and the borrower, and the grantor, the clients on the left here, make gifts for collateral or interest or partial insurance payments, premium payments to the ILIT. The ILIT then is the payer of any principal loan interest payments to the bank or partial premium payments to the insurance carrier, since they're the owner. And the ILIT is also the entity that posts the collateral. The bank issues the loan to the ILIT and then pays directly to the insurance carrier the premiums. Upon death, the ILIT is the beneficiary of the insurance policy, and then any ILIT assets, including the death benefits, will be distributed to the beneficiaries per the trust arrangement. And again, this is just a typical structure that is our focus today. Amanda maybe could speak to different arrangements that they see or ownership.
Yeah, no, thanks, Kim. This is an excellent example of what a traditional premium finance strategy looks like. I'm a very visual person, absolutely love menus with pictures on them, so I'm super excited that Kim put this together for us today. I did want to mention that there are several ways that a deal can be structured and many different reasons why somebody might finance premiums. So, as I mentioned before, Wintrust has been in the space for over 27 years. So we've seen every scenario you can possibly think of. We pride ourselves on taking a customized approach because we know no two borrowers are the same. So in addition to the traditional structure that you see here that Kim went over, it can be an effective method for other scenarios as well. For example, we often see LLCs as borrowers, buy-sell agreements, multi-participant deals, key person insurance, and split dollar, just to name a few. I'm not going to bore you with all the details right now, but I just wanted to point out that a premium finance strategy can be a good fit for more than just one type of borrower or scenario.
And the other thing I'll weigh in, Kim had mentioned that the ILIT is the guarantor of the debt or provides the collateral. Sometimes the grantors provide the collateral, and so they will post collateral on behalf of the trust. And there's lots of case law out there that says that that is not a gift, and when the grantors are essentially guaranteeing the premium finance loan, but we have a little bit more conservative approach. We think that that is valuable consideration that the grantors are offering to the trust, and so they should be compensated for that. So generally, we recommend that there's a guarantee fee or a surety fee being paid back to the grantors by the ILIT. And generally, that's anywhere from 0.5% to 2%. Generally, we see 1%. So if there's $1 million of collateral being posted by the grantors, the trust is compensating the grantors $10,000 that year for that collateral. And that's a very, very common thing that we recommend, but something that's uncommon in the industry itself. Kim?
Yeah. And so just some key features, high level, as we look to put together a plan to consider. One would be our insurance carrier and product selection. We want to ensure that the insurance carrier we are working with has high financial strength and is experienced with financing insurance premiums. And also know what are the guidelines. Different carriers are going to have different guidelines when it comes to this structure as it pertains to age, or even the ability to accrue a portion of the premiums or the interest due annually. And then after the policy is issued, what are the systems and reporting capabilities of the carrier? This is not a short-term plan that we put in place and then leave and let it sort itself out. We're checking on these annually and managing them on an ongoing basis. And we want to make sure that we can access information readily and accurately. Annual outlay and collateral discussions, just like a universal life policy that's purchased in a traditional way. There's flexibility in the outlay that we have in these plans. And so we want to make sure that the cost of the design fits the liquidity of the purchaser. And Ryan's going to talk more about this later in our discussion. But not just today, but we know that things are going to change along the way. And do they have the liquidity to be flexible within the design? for an annual cost and as well as posting collateral. What is this collateral like? And also, as we talk about collateral, what sort of collateral do they have available? And has it been clearly disclosed and approved by the lender? Because not all forms of collateral are observed equally, I would say. So cash is different than a stock that would be posted for collateral. For example, some lenders require that they have cash in hand as collateral, others do not. So those are just additional considerations to consider.
Real quick, we have had situations where we've had more exotic forms of collateral, but I would say that that is at the very upper end of the market. So if we have a family group, for instance, that is well north of $1 billion, and they have various financial institutions that they have relationships with, we've had situations where a letter of credit has been offered using an art portfolio as collateral. Now, the bank, the issuing bank of the letter of credit has to be very highly rated and accepted by the lending institution. It's generally not done by the same bank. They're usually two different banks, but there's things that are way out there on the fringes. But I would say that the more flexibility and adjustments that we can make really directly coincide with the level of net worth and the strength of the borrower themselves. Sorry.
No, those are great points. The third, very important for us, stress testing and discussion of downside risks. As Ryan already had pointed on, the illustrations that we show in our presentations are just that. They are illustrations. The presentation and illustrations shown during the point of sale should illustrate potential outcomes and be clearly conveyed that they are not guaranteed and based on a set of assumptions. Actual results are going to vary as loan rates change and as crediting rates inside a product fluctuate. So while we also like to begin with conservative and sound assumptions, but feel it's very important to provide some stress tested examples where we show what will happen when crediting rates on an indexed UL product are lower than we initially showed in our illustration. What does a time of an inverted yield curve look like that results in higher loan rates right off the bat from the bank, and just set the stage for discussing how net death benefit or return on this portfolio or plan can change over time. And then finally, discussions of exit plan. There are a few ways that you can exit, and what we mean by exit is the loan. So a lot of times we'll show exit at death, so loan repayment at death and net death benefit going into the trust in our example. They can also be repaid via cash value inside the policy and can be repaid via out-of-pocket funds or alternate funds outside the policy. Just a discussion of these alternatives and understanding that a plan at the point of sale, again, may change over time and having the flexibility to have alternative exits.
I think the big point here is a plan is only as good as the day you make it. And the only one constant that we can rely on is change. And so when we do an illustration, it's based on a static set of assumptions that we know from the outside are going to be wrong. So what we want to do is run those illustrations and lending assumptions as conservatively as we possibly can to make sure that we're going to be on the right side of wrong in terms of being more conservative or maybe too conservative rather than being on the wrong side, because clients inherently hate when they experience something that nobody told them about. And so when they get hit out of left field by something that nobody discussed because it was a no-brainer strategy and you can't go wrong with this, clients would rather have good news than bad news. Duh. So we just want to be in the right position to deliver as much good news as we possibly can. Amanda?
No, thank you. All great points. So I want to talk a little bit about the process here and maybe some tips and tricks on how you can make that process a little bit smoother for you and your clients. So, as you all know, there are several moving parts throughout the loan process. But by understanding the requirements and taking a proactive approach, we can significantly reduce the amount of time that it takes to close a deal and hopefully avoid any last minute fire drills or, just unexpected obstacles. So there are a few players in the game here. We have the lender, broker, advisor, the client, the carrier, on and on. So you're not always able to control how quickly and efficiently other people are completing their tasks. However, there are a few ways that you can help set your borrower up for success. My first recommendation would be to create a cover letter. So when you are going to lenders and requesting a term sheet or a proposal letter, in addition to the illustrations you provide, it's extremely helpful if you have a cover letter because the banks are going to need to know the who, what, when, where, and why. So they want to know who the parties to the transaction are, what is being pledged as collateral, what's the client's estate planning strategy. More importantly, they're going to want to know what type of deal structure you're looking for and how the client is going to repay the interest. If they are looking to pay interest in advance, the proposed rate may be a little bit different than if they're asking for the interest to be deferred. So it's important to put that information out there up front. That can help expedite a proposal letter and then just ensure that the information you get back is reliable. Another recommendation here is gather the lender requirements early in the process. Now, the first step is to know what those requirements are, right? And they're a little bit different from lender to lender. So I would never assume you know what they are because you definitely don't want to collect the information, go to the lender, and then have to go back to your client and get more. So at Wintrust, we have what we call a credit application checklist that we send out with our application. It's just a simple summary bullet point list of the information that we need to accompany the application. So we have a complete package that really helps us cut out some of the back and forth and delays on the back end. So highly recommend, reaching out to the lender early on to see what those requirements are and then gathering those requirements on the front end. Another way that you can make this a more smooth process is confirm the collateral early. I know that is not always possible, right? But making it a priority and providing the information when you can is key. We want to avoid any surprises late in the process. There's nothing worse than a client returning all of their signed loan documents, hoping that we're going to fund, in the next day or two, and then realizing we don't have the secondary or gap collateral account open or, the funds aren't available. So getting the information like the account owner is important to know. The account type is important to know. And I'm sorry, I lost the third thing. There are very important things to know here, but the owner and type are really important because, as Kim mentioned previously, different collateral is treated differently. So if the client is hoping to understand how much collateral they're expected to bring, if they tell us they're bringing deposits and cash, we apply a 100% advance rate. If they change their mind and they want to bring stocks over in a diversified portfolio, it might be a 70% advance rate. So sooner we have that info, the better. And then finally, trust and formation docs. Again, I know these aren't always available at the get-go. We often see applications where the borrower is ILIT TBD. which is totally fine. But we do need to have the trustee information and whatever information you have available as soon as it's available. If you have a draft copy of the trust or entity documents, it's extremely helpful for us because we can pass it along to our legal team and they can do a cursory review of that just to reduce or eliminate any surprises on the back end. And having those executed docs prior to the bank creating their loan documents is crucial because we're going to need to put all of that information in those loan documents to be able to get them out to your clients. So, as I mentioned initially, a lot of moving parts here, a lot of people involved in the process. But if you keep these things in mind, it's going to help us finance that premium for the client in a timely manner and on time. So,
Okay. Next, sorry, we'll go through maybe the timeline here, what it really looks like.
yeah. So, I just talked about all the players in the loan process, the lender being one of them, obviously. So the lender affects the overall timeline when they prepare a proposal letter, when they underwrite the deal, when they prepare the loan documents, and then they fund. So that's when the ball is really in your lender's court. The average number of days that it takes to fund a loan from initial inquiry all the way to financing the premium is about 65. But keep in mind that includes the time it takes for the clients to provide financial information, collateral information, sign loan documents, establish gap collateral, get counterparty acknowledgments and all of that. So very start to finish, average is 65. It's not uncommon for it to be less. Sometimes it's more. Just depends on the situation. And again, if you kind of follow those recommendations on the last page, it can help speed the process along. So at Wintrust, we typically provide a proposal letter within 1 to 2 business days of getting the request from you and receiving those illustrations. If the client wants to proceed, once we have a complete loan application with all of the financial information, it's about 5 business days for our new business team to get an approval and issue an offer letter for you and your clients to sign or review and sign. If the client does want to move forward and they return that signed offer letter, our in-house legal team can start the process of preparing documents. Now, assuming they have everything they need, meaning collateral account numbers, trust documentation, that process typically takes 5 business days, potentially less, for them to turn around the docs and get those out to your clients for signatures. Once we get signatures back from the clients, we get all the counterparty signatures, we're ready to close the loan and to send the wire to finance the premium. So that's a general kind of high level of a timeline. Again, every deal is different, but just to give you an idea of the process itself. So Ryan, Kim, did I miss anything?
Well, I'd just like to say with collateral, there's a wide range of collateral. So collateral could be cash, it could be securities, it could be cash that's already outside of the estate in either the trust that is doing the financing, or maybe it's another trust that's guaranteeing the collateral on behalf of a sister trust, so to speak. It could be existing life insurance policies. You might have a client that has lots of existing cash pay life insurance. We had a client not too long ago that had a large portfolio of whole life insurance that was fat with cash, and we could use that. And Wintrust gives us 100% collateral or loan to value or advance rate on that whole life cash value. And it's important to note that there's a difference between even a stock and bond portfolio and cash, and we're getting 100% advance rate because the banks generally view insurance by a credible insurance carrier as a tier 1 asset. This is a high quality asset in the eyes of the insurance company, but it could be a letter of credit. It could be a lot of things, but what we have to do, and Wintrust is really well known for being creative. We have to still make sure is it's a prudent investment on behalf of the trustee or a prudent strategy on behalf of the entire family group. So just because we can do something doesn't mean that we will. It needs to be in the best interest of the client themselves. This is a typical premium finance RFP summary that we will go through. And Kim, you can really talk at a high level about what we're seeing here.
Yeah, this is just really a snapshot to, at a high level, talk about the interest rate and how we might initially look at that as the cost and send an RFP out to different lenders, and then want to go with the lowest lending rate. But there's a lot more to consider along with just what your all-in interest rate is beginning, including how the interest rate is calculated. There's, if you can see in the third column, there's different benchmarks from the 1-year CMT to prime, and the 30-day average versus overnight SOFR, plus the spread that the bank is including. And so these are pieces to consider, as well as the length of the loan commitment. A 1-year loan commitment will have a client go through a full underwriting process and renewal on an annual basis, where a longer term length of loan commitment will not. And so that's valuable as you look at administering these plans on a long-term basis. And you can also see in the final column that the lenders also value the cash value. We've talked about that differently inside the insurance policy itself that you're funding. So which will reduce, if you're at 100%, the need to post higher GAAP collateral. So typically between 95 and 100% is what we see. There's other items not posted on here. A lender might have a lower interest rate, but could have upwards of $10,000 in fees year one for the loan. Wintrust, for example, does not have any additional fees year one. And so that's another piece to consider. What else? Do assets have to be held at the bank, to, like cash in hand, for the collateral, or can they be held outside? Do they have alternative lengths of commitment? This is just a snapshot. Once you've kind of honed in on some lenders, there's additional conversations that can be had to really fine tune these terms. Do they have fixed rates, and what would the breakage fees be for those agreements? And does an existing relationship with the lender help your borrower? Does that play a role in what you can achieve? So these are point in time values based on a particular circumstance, but just provides a good snapshot of the difference between lender alternatives.
Yeah, it's important because some banks will not even do the premium finance loan unless the client has a minimum $5 million or $10 million investment mandate with them. Wintrust is famous for not requiring that, and they're not going to actively try to poach other banks' wealth management clients and what have you. But more importantly, it's ease of administration on the back end, not just for us or the bank, but for the client. And I think that's one of the big reasons why we will do a fair amount of business with Wintrust, probably more than any other bank, is because of the ease of administration and actually working with the client. But the spread will go down in some cases based on the assignment, the wealth management assignment, or other profit centers that the bank has with that client. So if you've got a client that has $100 million in wealth management mandate with that bank, maybe they have an aircraft loan and they've got other debt financing, you'll see spreads really compress. So we've seen spreads sub 100 basis points on 30-day average SOFR, for instance. The one thing I'll point out, you'll see, for instance, Wintrust is at 1-year CMT plus 200 basis points. Well, CMT at the time that this was put together was at 369, whereas SOFR is different, is right around 4% right now, depending upon if it's 30-day average or overnight SOFR. And so just because the spread is different doesn't mean that it's necessarily better. So just don't get fixated on a 2% versus a 135 spread. The underlying indice that we're working with makes a big difference. So we're going to start with polling question number one. Again, if you have any questions, please feel free to ask them in the Q&A function, but we'll go ahead and keep moving. So, okay. Who's got,
Okay, that's me.
yeah,
So let's talk about some common errors and pitfalls. Um, First and foremost, believing premium finance is a one-size-fits-all solution. It's not. It just isn't. So, back to what we mentioned earlier, there are a lot of reasons why financing life insurance premiums might be a good fit for a client, but that doesn't mean it's a good fit for every client. Ryan did a great job of outlining the characteristics of an ideal client earlier, so definitely defer to that. It's very important that you do that at the beginning of the process. If a client has an unpredictable balance sheet, they're really illiquid, they can't post additional collateral calls beyond the initial financing year, they're unable to make the planned gift to an ILIT to cover a planned outlay. Maybe they deviate from their original plan without consulting their advisor. They might be uncomfortable with debt and leverage. Those are all examples of why this strategy just might not be a good fit. And we definitely don't want to see a client commit to a strategy that they can't support, that'll potentially put them in a compromised position later, because we all want to do what's right for our clients, right? And so being able to identify the ideal client is crucial. Another common error or pitfall, assuming the best lender rates are always the best bet. Kim and Ryan just covered this beautifully. And I second everything they said. I love this one, not because I'm a lender and I like to make money, but because there are a lot of things to consider when you're trying to find the best fit for your client, and not all of them are obvious. Like, I get it, rates are flashy, and so if a client sees two different rates and one's 10 bips lower, they might find that really attractive, especially in a higher rate environment, but it's important that they understand everything else that goes into it. So Kim and Ryan mentioned, fees. Make sure to look out for loan documentation or origination or renewal fees. Wintrust, we don't charge origination or loan documentation fees for our standard 5-year variable rate term note. We simply get paid back through interest. So there are no upfront fees there. It's important that you ask the lender. Terms, as Kim mentioned, various terms. So maybe a longer term option has a little bit higher rate than a 1-year term. And she explained, 1-year terms are high touch, high contact. Some premium finance arrangements offer shorter terms and they have different call provisions. So a 2 or 3-year callable term note would mean possibly having to move a loan in year 2 or 3 due to an unreliable lending source, and that can be frustrating. Our 5-year term note is renewable at maturity, and it's not callable unless there's a default. Some conditions to consider. Prepayment penalty, does it have a breakage fee? Things change. Client strategies change. Is the client in year 2 or 3 going to want to pay off, via refinance or cash value or liquidation of other assets? And if so, is that going to cost them? So that's important to know up front. Asset reallocation, Kim and Ryan touched on this. Some institutions require that the gap collateral or secondary collateral be held at that bank, whether that be an investment account or a deposit account. Other lenders will require a certain amount of AUM on top of the gap collateral requirement to come over to them before they will issue the loan, a premium finance loan, and also to mitigate the lower rate that they're offering. So just be aware of those things. If it's a good fit for your client, that's great. As Ryan mentioned, Wintrust Life Finance, we don't require that. As I mentioned previously, we are part of Wintrust, which is top 40 bank. So we can be full service if your client is interested, but we don't require it. And we do take a third-party brokerage accounts so your clients don't have to move their assets over to be pledged as collateral. Another important consideration is lender risk. So not all lenders are created equal, and you need to determine, if the lender that you are working with is committed to the asset class. So look at the number of deals the company's done, look at the track record. It'll give you a better understanding of how reliable that lender is. We've been doing this 27 years and we've seen a lot of people come in and out of the space, right? So it's not for everybody. We're not the only guys in town, but there are a lot of good other lenders out there. You just need to make sure you're doing your research. We've refinanced our fair share of deals that had to move because the previous lender decided they didn't want to do this anymore. They're getting out of the space. It's really nuanced. It's not a mortgage. It's not an unsecured loan. So just make sure they know their stuff. Execution, you want to make sure the lender and the credit committee understand the product and transaction to the extent that you can. There's nothing worse than getting, a low rate offer, getting really excited about it, and then spending the next few months battling the credit team and just putting you and your client through, potential nightmare and then needing to refinance elsewhere down the road. So if the lender doesn't fully understand life insurance policies, it might result in increased collateral requirements, potentially notices of default based on financial information, timing of policy crediting, etc. So just kind of ask yourself, has the company worked with the carriers in question? Are they comfortable with the assignments? And just make sure you understand all of the requirements, the process, and the estimated timeframes up front. So another one, promises of no cost or paid up insurance solutions. Ryan mentioned free insurance previously. There's no such thing as free lunch. We hear this all the time. So let's be clear. Premium finance isn't a gimmick. It's not free insurance. It's never been free insurance and never will be free insurance, right? It's not a play on the potential arbitrage between policy crediting and interest rates. So your client's going to have to pay interest and they're going to have to post collateral equal to the difference between the cash surrender value of the policies and the loan balance. It's simply a tool for them to use to help them reduce their initial out-of-pocket expenses relating to the purchase of the insurance that they need, while allowing them to keep their current money working where it's working for them. So they may be making 10 to 15% in real estate or investments, and they don't want to pull that money out or liquidate it to make a premium payment. Instead, they're going to borrow at 5.5%, 6%, make the interest, and keep that money working for them elsewhere. So that's a pretty important one. And then unreasonable product illustration and lending assumptions. Ryan and Kim, feel free to jump in here if you have something to add. I know you've kind of touched on it previously. I think it kind of goes hand in hand with the next bullet, the inadequate stress testing or discussion of risks, because in general, transparency is key. It's really important. Things can change, they will change. As much as I'd like to say I know what's going to happen in the next 5 years, I don't. And I don't have a crystal ball. So just make sure your client is fully aware of the risks. You don't want them to be surprised and disappointed when, the market's down, rates are up, and they're asking, what did I get myself into? So anything you guys wanted to add there?
No, I think we're going to cover it later.
Okay, cool. Okay, and then Kim covered exit plan alternatives as well. I mean, the key being have a plan B before it's too late, and there are many different exit plan options.
Perfect. And there's some gift and estate tax considerations. So The loans to the trust are estate, gift, GST, and income tax free. And so again, like I said, we will need to potentially have a guarantee fee if the grantor is guaranteeing that collateral. It's just a good belt and suspenders approach. So if the IRS did try to come in and attack the strategy and that was valuable consideration being offered by the grantor, I think it's important to make sure that you cover that potential issue, even if it's small. We've got a really large asset, sometimes as much as 20 to $100+ million in insurance that we're financing. There's no reason to put that plan in jeopardy. Obviously, we'll have reduced outlay compared to traditional funding. However, this should not be the sole reason for doing it. But when we have reduced outlay and the client is making those contributions from the estate, obviously there's reduced gift tax considerations. We need to make sure that we've got proper ownership, especially if we're doing it in a wealth transfer strategy. We need to make sure that the asset is outside of the taxable estate and we're not doing anything that's going to jeopardize the integrity of that structure. And again, that guaranteed collateral, the grantor guaranteed collateral, if it's necessary, we want that guarantee fee in place. But a lot of times we're using existing assets that have already been transferred. So it's often combined with those other successful estate planning strategies, either a defective trust sale that has maybe it's a business that's monetized and now there's an abundance of assets that are outside of the estate in a dynastic trust structure. We see it where we see existing brand new defective trust sales where we're using the delta between the required interest rate and the cash flow that's generated inside of the trust as a mechanism to cover the carrying costs of the insurance, whether it's cash pay or if it's premium finance. But this is a great way to leverage our limited exemptions, which is going to be $15 million per individual coming up. This is a great way to lever those exemptions, specifically the GST exemption, and creating an abundance of dynastic assets outside of the estate. It's a great premium finance is a fantastic way to increase or augment any estate plan. Looks like we have a question. Kim, do you want to?
Yeah, I was going to pose this to you, Ryan. Just if you were posed this question from a high view, would you say the question is the strategy most beneficial when collateralized assets are earning a return well above current loan rates? So you're pocketing the delta between the interest rates and investment returns since premiums are staying in your pocket. What's your response to that?
Yeah, it is. I think there's really three forms of arbitrage that are experienced through premium finance. You've got what I would have spent on insurance versus what I'm spending to finance. And if I'm able to retain that capital, and we have a retained capital analysis, if I'm getting a 6 to 12% return, but I'm borrowing at 4, 5, or 6, and I've got that spread that's there. We have an income, estate, and GST tax arbitrage. And there also may be a product arbitrage. So I'm essentially borrowing short at overnight rates or 1-year CMT rates, and I'm investing long in the life insurance. And so over a 30 to 50-year period, there's going to be a defined spread there. But that's going to expand and contract. It may be inverted at times, whether we have an inverted yield curve or if we get a zero because the market has gone down and we were using an index universal life product. But if you fundamentally believe that overnight rates are going to be lower than long-term rates over a 30 to 50-year period, that's where premium finance really, really works. But there is the first form of arbitrage, which is what the question was based on, which is if I can borrow at a rate that is lower than what I can earn in my portfolio, there's obviously a benefit there. Yeah.
Thanks.
So then there's integration with, other planning. So integration with the client's cash flow planning or the trust cash flow planning, income tax planning, estate planning, sometimes spousal security planning. We often view spousal security planning as only a lower or middle market or mid net worth type of problem or issue that we're trying to solve. But we're working on a case right now where the client wants the wife to have $150,000 net after tax a month, regardless of in the event that he were to predecease her. And we're going through a calculation and seeing here's what she needs in order to provide that. Here's what they have. And what's the delta? It's just a math equation. And then we can fill that gap with additional insurance. And then they also have an estate tax problem. So we're really solving two, three, four problems with one solution, or killing two, three, four birds with one stone. And so we can structure single life insurance in a spousal lifetime access trust that can not only cure this spousal security deficit, but it can also be there to solve an estate liquidity need at the same time. Sometimes it's a business succession planning issue. So we want to have the business bought out of the estate at the death of a founder or one of the grantors, whether that be the husband or the wife, whoever the primary breadwinner or primary driver of that business. And mom or dad, whoever the alternative spouse is, wants to be financially secure, independent of the future success or failure of that business. And so we'll have insurance in a trust. It funds. We usually structure that very close to what the spousal security need is. And then we buy the business out of the estate at mom or dad's death, whoever that person is. And now there's cash in the estate that mom or dad can live on. And the business is now in a trust for the benefit of the kids or next gen owners and managers. And now mom is not having to have conversations about the business and having the kids say, Mom, we're looking to expand the business. Can you sign this capital loan that we're going to go out and acquire companies? She's lost her in using mom, but obviously I don't want to be sexist and pretend that it's always a male and a female in this order, but just for the sake of this example, mom is she's lost her primary representative or proxy in the business, and now is tied to this illiquid concentrated equity position. And now she's being asked to sign loan docs or take on leverage to grow the company. Sometimes it's better to put mom in a much different or much more secure position. So we see this not just in a first step buyout, but it could be other business succession planning. It could be a key person buyout. It could be a lot of different things. And again, we don't want to walk to the job site with a hammer and pretend that everything is a nail. Every case is completely different. Again, we have our polling question number 2. Please pay attention and answer that polling question for us. And we're going to continue to move on with a case study. And again, we talked about this because we see it a lot. We get a lot of you folks that are on this call that will send us over these free insurance type of strategies where somebody has been promised zero or low to no outlay in return for a lot of insurance outside of the estate. So this client was a female, age 66. She had a life expectancy of 16 years based on 2 independent life expectancy studies that we had done. This was brought to us as a review because the female was in a position where she had premium financed 3 policies: a Voya Index Universal Life Policy, a Securian Index Universal Life Policy, and a Mass Mutual whole life policy. And the whole premise of the plan was that she was going to have zero outlay, and all she had to do was post collateral to get this large amount of insurance. I think, Kim, the total death benefit on this portfolio is in the $55 million range at this point, with a large loan of approximately $25 million, and she just had to provide the collateral. Well, she didn't need this much insurance, and she didn't want to have it anymore. She had some pretty big additions that she wanted to put on her house. She was collateralizing the portfolio with the stock portfolio, so her advance rate was more than whatever the collateral shortfall was. And she just wanted out of it. And she talked to her advisor about it. The advisor brought it to us because there was you'll see about an $840,000 delta between the loan balance and what the cash value was. So they thought that was going to be their only cost of exiting this free insurance or zero outlay strategy. And because of the increased interest rate environment that we went through over the last few years, the collateral amount was creeping up because, again, when you're capitalizing higher interest rate, that's compounding as a liability against the policy itself. So this is a snapshot of the portfolio. So we've got this first policy, which is the SLD or Security Life of Denver. Voya is the company now. It's got a surrender value of 10.4 and a death benefit of a little over 25 million. The Securian policy that is $18 million in death benefit, and the Mass Mutual policy that's about 12.5 million. So a total of 56 million in total death benefit. This cash surrender value, the policies have been performing well. However, the cap rates on these index universal life policies have gone down significantly. And so the performance isn't as good as what was originally projected or expected. More importantly, the premiums that have been paid into these policies are $14.5 million. So that's our basis, or what the client has or the trust has invested in there. So we've got surrender value of 24.5 and premiums that have been paid, or a basis of 14.5. We've got a gain in there. And so again, they thought this $837,000 projected deficit was what their exit cost was going to be of this free insurance program. As we went through our analysis and just knowing basic life insurance characteristics, we knew that this cost was quite a bit more, because the policy was projected to have a gain in the contract of $10.6 million. So if she surrendered the cash value, it's true she would only be have a deficit of 837,000, because our total surrender value is at the end of the 16th year was going to be $25.12 million. Our total loan balance was projected to be at just under $26 million. But there's a gain, a taxable gain. So when we went back to the attorney who brought this to us, we said, you have a grantor trust that's going to surrender these policies that only have $14.5 million in basis. There's $10.6 million in gain, assuming a 55.2 ordinary income tax rate in the state of California. That's going to mean another $5.8 million in exit costs. So to exit this free insurance strategy, it's going to cost the client just under $6.7 million. She was having heartburn over posting collateral and potentially coming out of pocket $837,000. When we came back and said it was just under $6.7 million, she poo-pooed a brick. She was not a happy camper. And so we're looking now, our message to that person is that the best exit for this is to continue to collateralize it and die with the policy, or begin to start paying some sort of contribution or premiums, or some of the carrying costs of this big loan is another one, but that was not an option for her as well. So we're trying to figure out some alternative strategies or an exit for her as we speak. So anything that you'd like to add here, Amanda, because I know you guys are often approached with zero or low to no outlay strategies, and where does it make sense? And it's usually these are presented to people at the lower end of the client demographic that should be doing premium finance, and it really belongs at the extreme upper end, where you've got client with adequate collateral, adequate positive net cash flow. That's where it may be a much better, like I said, it's got to be a well-qualified bar. Anything that you would add here?
No, I think you're spot on there. Unfortunately, these do still come up occasionally. A little bit of education needs to happen. It needs to be the right fit for the client. And also, unfortunately, the scenario that you just went through, we're starting to see a little bit more of that where this maybe was implemented quite some time ago, and now they're seeking advice from experts like yourself on what they should do now and what the next steps are. So we are seeing kind of an uptick in those scenarios, but it's just important to keep an eye on it and stay focused.
The original, for instance, one of the policies, the illustrative rate was like 8.76, if I remember correctly, Kim. And the max rate that we can run it at now is a little over 5%. And so you can imagine that 300 basis point delta between what they originally sold the client the strategy based on versus what they're able to actually illustrate today does not paint the same picture. It's not the rosy picture that it looked like from the get-go. Obviously, the policies have performed well. Otherwise, you wouldn't have $10 million in gain inside of the contracts. But on a go-forward basis, because of cap rate compression, because of the persistent low interest rate environment, that ends up being a bit of a problem. And that's something that while we do a lot of premium finance with Index Universal Life, what I'd like to do is just talk to you a little bit about product, because Index Universal Life is a great product for the right client with the right complexity and risk threshold. But Index Universal Life also comes with three primary risks. You've got interest rate risk, because the policy's cap rate is largely dependent upon the long-term interest rate environment or the yield, the portfolio yield of the life insurance carrier. You also have, volatility risk, because the index cap rates are also based on the VIX, or the volatility index. So the higher the cost of that index, the lower the cap rate is going to be. So you have volatility risk. The last one you have is market risk, because the market has to move in a specific direction in order for it to work. It doesn't mean that these aren't good products to use for premium finance. Again, we use them quite a bit, but it's something to understand. And so what we're going to look at this point is a premium finance whole life, which is our favorite way to finance a product, because whole life, it's that old dividend paying, stodgy grandfather's whole life, which we used to despise, because whole life is really good at accumulating lots of cash value, and it compounds cash value on a regular basis. It's not really good at the exit or pulling money back out of it, depending upon the carrier. Some carriers are better than others, but it's very predictable. It never goes in reverse. Every time a cash value or a dividend gets credited to a contract, it becomes a guaranteed portion of the contract. Whereas with Index Universal Life, if I have a floor of 0, so I'm guaranteed to get no loss, I still have charges and deductions that come out at the end of the year. The cost of insurance, contract charges, all of those things. So the policy will go down in cash value from year to year. Kim, did you want to say something?
No.
Oh, okay. Sorry. So we're going to go through premium finance whole life. We're first set the stage. This is a female client. Her brother had already gone through this. It was a multi-generational, large family business out of the Midwest. She was 55 years old. She really had, we had gone through some extensive financial modeling to determine what the liquidity need was. And she had to define a state liquidity shortfall of approximately 58 million, but we're going to look at 50 million of coverage because they were going to do some other strategies to help mitigate some of that liquidity shortfall or the estate tax obligation. The trust had some cash flow constraints because her brother had done some large defective trust sales several years ago when the AFR rate was at or near 1%. She was a little slow to the estate planning party, so to speak. And when she did her defective trust sale, the long-term AFR rate was at a little over 3.5%. And there was some transfer restrictions on the stock. And so while she had sold some of the stock, she was retaining it because she wanted the dividend cash flow and what have you, because she was not as active and didn't have the CEO role that her brother had. And so her stock has to go to only lineal descendants, and she has one daughter. She can't leave it to a spouse because it only could pass to lineal descendants. So that triggers a first death estate tax liability. And so her daughter was her sole beneficiary, and we needed to make sure that there was sufficient liquidity so it would not put additional strain on the estate or the other surviving shareholders.
Right. So as we walk through this with clients, again, we can't hammer home enough that the first step Ryan just went through is that we've established a liquidity need. We're not out here selling premium finance. Rather, we've identified a need and we've identified insurance as the solution to the need, and would like to present different ways to fund that the solution to this problem. So the first would be to fund the insurance out of pocket or pay premiums, as you know, the majority of people do. So we were looking at a 20 pay and a level pay universal life product here. We're comparing the total outlay at life expectancy, the annual out-of-pocket cost, as well as the internal rate of return, or IRR, at death or at life expectancy for this client. So this will be the basis of comparison as we look at what our projections of financing the premiums, what those results will look like. We'll refer back to the funding out of pocket.
And since she was late to the party and the stock that was being sold was a C Corp, and then there was also an IC Disc, which is a separate international service corporation that had some positive cash flow, there hadn't been a long history of declaring dividends. And because the AFR rate was higher, much higher than our brother, there was compressed cash flow in the trust. And so the idea of paying $547,000 or $433,000 out of pocket was not attractive because there just wasn't that much predictable positive net cash flow inside of the trust itself, because it had to service the loan, the AFR note that was there from the defective trust sale, and there was some excess cash flow, but we didn't have a lot. And when we look at premium finance, if we look at this IRR, the 20 pay being the higher IRR at life expectancy, age 92, it's 5.31%. And or pre-tax equivalent yield of 8.17. It's not bad. But when we look at financing anything, anytime we apply leverage to an asset, all it is a magnifier of risk of the underlying asset that we're levering. I don't care if it's a piece of real estate, a stock portfolio, or a life insurance policy, it's a magnifier of risk. And so when we look at financing, we look at it should be at minimum 150 basis points of additional IRR over the cash pay strategy in order for it to make sense. So instead of 5.31, we need to be at a minimum of 6.81 or higher in order for us to really consider premium finance to be a viable strategy for that candidate. And so we'll go through and evaluate and see if that makes sense. The other thing I'll point out is we're using high net worth mortality here when we go through and establish life expectancy. Often we see life expectancy estimated at 86 to 88 years old. For our clients that have access to and are more compliant with better healthcare, lead healthier lifestyles, their life expectancy generally is anywhere from 3 to 5 years longer than the general population. And so if I were to back up my life expectancy, it'll show me an artificially high IRR. The further I extend it out, the lower the IRR. You can see it start to denigrate or deteriorate over time. I think having a reasonable life expectancy is always important when evaluating any life insurance as an investment for the family group. So in terms of just the overview, in cash value life insurance, a lot of you know this, so I'm going to go through it very quick. We have long-term tax deferred or tax-free growth. In this case, we're going to be financing whole life. So 100% of the portfolio is correlated to the long-term interest rate environment. So Moody's AAA bond index or the 10-year treasury plus a spread. And we've got access to that cash value. And again, we'll go through this in a minute. I'm sorry. It's a liquid asset, but it's also designed for liquidity. We've got guaranteed policy loan provisions. It can be used as collateral for a bank. Again, especially whole life is generally viewed as a tier one asset. And we can have access to the cash value on a first in, first out basis or FIFO tax treatment, meaning that we can get tax-free withdrawals out of the policy if we need to withdraw cash value to retire some or part of the loan itself. In terms of the overview, the general overview, it's very simple. We're going to borrow short, again, at overnight rates or 1-year CMT, and we're going to invest long in the life insurance. And again, we have it directly correlated to that long-term interest rate environment. Now, and I'll talk a little bit about that in a second. Now, again, that is going to expand and contract in terms of that spread, or it may even be inverted like we were for a couple of years. But in general, if I fundamentally believe that overnight rates are going to be lower than long-term rates, the strategy really holds a lot of water. There's no gifting, and we've talked about that. When a bank loans to a trust, it's income, estate, and GST tax-free. And if we have the right borrower, again, that's where we have that $100 million net worth as being an ideal borrower, minimum of $50 million. We can have flexible cash outlay in some cases where we can accrue interest, we can pay full or partial loan interest, or even pay full or partial premiums. And again, we've got the bank that's borrowing, or the trust is borrowing money from the bank, and the collateral or gap collateral or difference between my loan balance and the cash value can be either provided by the grantor or the estate, other trust assets, or existing life insurance. Existing life insurance is one of the most underrated collateral sources that we see out there. If you've got policies that are fat with cash, they can really be leveraged. That's a lazy asset that's just sitting in the trust that can be leveraged with an overlay of a premium finance strategy to augment existing life insurance planning. And again, when I was talking about the whole life being directly correlated to the long-term interest rate environment, there's a direct correlation, but there's a lag. So with whole life insurance, and we're going to look at Penn Mutual, their average duration at the time that we put this together of their portfolio is about 6 years. And so there's going to be a lag of anywhere from 18 to 36 months between a movement up in the long-term interest rate environment and a corresponding increase in the dividend interest rate. And that's because they've got this portfolio that's, again, 6 to 7 years and average duration. So they're burning off lower yielding assets and adding new money. And so it takes time for them to increase their dividend interest rate. But over time, and we'll take a look at it and see how that actually works, over time, you'll see that correlation. And we've got a great example of that here in a second. The first thing that we look at is the policy itself this is not a premium finance ledger. This is what's going to be financed, this $4 million a year over 8 years. And depending upon the age of the client, we may try to get the money in over 6 years. Older clients, it might be anywhere from 10 to 12 years. In this case, with this client, it's with a 54-year-old female or 55, I think it's 54-year-old female. We're doing 8 years, but she's paying via the financing, $4 million a year. Sorry, $4 million a year. You can see our cash value in the first year is very close to the cumulative premium, and that's because we're using specific riders and dialing down compensation as much as we can. Generally, you don't see that being as close to the premiums paid. But then our cumulative premiums paid versus our cash value crosses over right here in year 6. And really just after year 5, you can see it's pretty close to being equal. And our IRR on our cash values is right around 4.7 to 4.8%. Not great. And our death benefit IRR is 5.17%. And that's because it's accumulating this massive amount of cash in here. And again, that cash is never going backwards year to year, because every time a dividend or a cash value gets credited to the contract, becomes a guaranteed portion of the contract. The reason why there's not a big difference between my cash value IRR and my death benefit IRR, because the net amount at risk, if we look, there's really only about $22 million, $23 million of pure insurance in this strategy itself, because it's a whole life contract. But now let's look at the premium finance ledger for this. And this is a specific design. And I think when Amanda talked earlier, this is just one design. This is not every single design, and this is specific to this borrower in particular. But we've got, again, this is the amount of money that's going into the policy itself. We have designed this as a capped or level outlay, which we do in some cases, because clients can either pay just the interest that's accruing each year, they can pay a capped or level outlay, they can pay part financed and part cash pay. There's lots of different variations. In this instance, we did a level outlay. So it's $300,000 a year for 20 years per collateral, or the trust collateral requirement. You can see that it peaks out here in the 5th year at just under 2.4 million. And it's important to note, when we calculate our collateral column, we're doing 1% off of the current dividend in the first 2 years, just to be a little conservative. Again, we want to be on the right side of being wrong. We want to come back with better news, not worse news. But look at our IRR at life expectancy. We were at 5.31. We're now at 9.04%, which is quite high. We've picked up a little over 380 basis points, or just under 380 basis points of additional return by using the financing. And so what that tells us is a lot of things can go wrong. It can survive some pretty strenuous stress testing and still be in a good spot. In terms of this client, she qualified for 30-day average SOFR plus 140. And 140 is the loan spread offered by the lending institution. And they're giving us, contrary to Wintrust, giving us 100% on something like this. They're giving us 95% loan to value or advance rate, on the premium finance loan itself. Probably the most important assumption on this page is the loan interest rate. And so you can see at 30-day average SOFR plus 140, we're at 540 in the first year. And then Kim puts together a kind of a projection of what, based on the forward-looking curve, interest rate curve, of this coming down over time, ultimately to what we would refer to as a normalized borrowing rate. And so are we saying that interest rates are going to be 390 forever? No, we don't know what interest rates are going to be. All we're trying to demonstrate is the delta, or the spread, between the dividend interest rate and the borrowing rate, which in this case is 210 basis points. And so if dividends were at 7%, we're saying that our borrowing rate would be at 4.9%. And so that's a theory, but what we want to do, we are big believers in that evidence defeats doubt. What do you have to support your theory that the interest rate, or that spread between my borrowing short, my premium finance loan, investing long in the whole life insurance? How can you prove that out? And we'll go through that in a second. This is a retained capital, going back to that original question, a retained capital account. So the traditional financing we know is 540, or traditional cash pay is 547,540 a year for 20 years. Our premium finance outlay is projected at 300,000 a year, and we always tell the client it could be higher, it could be lower. It just really depends on the performance of the overall strategy. So what they're not spending on the insurance cash pay scenario or strategy is 247,540 each year. And so we show or demonstrate, just at 5%, if the family group or the trust were to invest that, over the life expectancy of this client, there's just under $20.7 million of additional capital that can be added to the overall strategy. So we've got a net death benefit of $79.9 million plus the $20.7 million. So the combined benefit of the overall strategy is just under or just over $100 million to the family group versus $50 million. This, to me, is one of the more important pages, and I'm going to attempt to blow this up, or maybe I won't, because I'll screw things up. But this is how we prove out or how we calculate the normalized borrowing rate for a whole life contract. And so what we did is we went back to 1986, which was the first data point for 30 days LIBOR, which has been the gold standard for short-term borrowing for quite some time. And so we looked at the Penn Mutual dividend rate starting in 1986, the 10-year Treasury, and then the spread between those two. And we'll go through why here in a second. And then we also looked at 30-day LIBOR versus the Penn Mutual dividend rate and the spread between those two. And what we find is over this 39-year period, our average dividend rate is 7.3%. The average 10-year Treasury during that time period is 4.67. And the average spread between the 10-year Treasury and the dividend rate is 2.63. It's funny because I presented this slide to the president or to our study group, and Penn Mutual, this company, and their CEO was in the room. And he said, your math on that one slide was interesting. And the Dave O'Malley, the president and CEO, also used to be the CIO. So he's very familiar with these spreads and what have you. And he has the most amazing poker face on the planet. And so I was incredibly nervous about what this interesting fact or interesting math is that I had on my slide. He said it's actually conservative. Our spread has generally been higher than that because what you're not taking into account are other alternative assets that add another 5 to 20 basis points onto our return. It's not just the spread between the two. And so, which made me very happy. The average 30-day LIBOR is 350, and the average spread between our dividend rate of 730 and 350 is 379. But we can't borrow that money for free. So we have to apply our 140 basis point loan spread. So our actual average spread over that 39 period between the dividend rate and LIBOR plus a spread of 140 is 239. So if you remember, we're using 210 basis points as our assumed normalized borrowing rate. And that's because we go one more step further. We take the dividend rate of 6%, and deduct the average spread of this 239, and we take another 25 basis points off of that. You might ask why. That's the average rate over that period of time. It's because of this period right here where we had short-term borrowing rates at or near zero. And if we were to lop off this 10-year period altogether, it would be a 50 basis point adjustment. We were advised by some of the more sophisticated fixed income teams, don't take the entire 50 basis points off because you don't ignore that period altogether. Take half of it off. And so we deduct another 25 basis points off of that 239 to arrive at our normalized borrowing rate of 386. We round to the nearest tenth. So when you see this borrowing rate of 390 persist all the way out, that's where we're coming up with that. We're rounding up to 390 in order to have an acceptable normalized borrowing. So just a little bit of insight as to how we develop our assumptions and what we do. This is just a look at the forward-looking SOFR curve, where we're at now, where it's projected to go. We do these and update these every 2 weeks because they change all the time. And so this is another example of if all these things prove is that paper can hold ink. If we look at the 10-year Treasury projection, it's projected to crest over 5% in the next 5 to 7 years. What does that mean? Well, if I've got a spread of 263 over the 10-year Treasury, our dividends are going to start to revert back to that historical mean of 730. So again, there's going to be a lag, that 2 to 3 year lag of the rise in the long-term interest rates and a corresponding rise in dividend interest rates. But we're going to see those go up. So again, we're not saying that interest rates are going to be at 390 forever, but we know that the dividend interest rate isn't going to remain at 6% forever either. The next thing I'll go through is, because this client's brother asked, what's the worst thing that could happen? And I said, well, we could, if we were like in a 6-year inverted yield curve environment. And he said, well, that's ridiculous. There hasn't been a inverted yield curve that long in the history of the financial markets. I said, yeah, but if you look at the catastrophic financial testing that a company like Penn Mutual will do on their own portfolio, they will model out a 6-year inversion period to make sure that the portfolio can survive. And so we leave our loan or lender interest rates at 6.5 for the first 6 years in order to demonstrate that inversion period. And then we have the interest rates gradually coming down to that 390. You can see our collateral is much higher. We crest out at 5.225 million. But our IRR has not deteriorated a lot. We've still got an 8.44, a great compensation for that additional risk and complexity of the premium finance strategy. And so, although this is an unlikely scenario, it's good to put in there. But more importantly, it's good to put it in the beginning, because when you have that negative experience at the start of a strategy, that cascades and compounds through the rest of if I did this same scenario, for instance, in the 24th through 30th year, it might not look as bad, but it looks way worse when I do it at the very beginning. And that's what we want to do with our stress testing.
How much time do you say you spend talking about the later years of the illustrations, whether it might, like, how much focus is on early versus later when you talk about projections and stress testing, etc.?
We spent a lot of time talking about it, and but we also don't want to spend an inordinate amount of time because we don't know. We don't know where rates are going to be. If any one of the three of us on this call knew where short-term borrowing rates were going to be or long-term interest rates were going to be, I guarantee you we wouldn't be doing this webinar. We would be far more wealthy and would not be doing this to educate you folks, which is a form of obviously of marketing. But we really want to make sure that we've got the proper stress testing going on, and that we monitor this on an annual basis. So we're going through very extensive reviews. So we talked a lot about lender selection and going with a bank that has experience in doing premium finance. I think it's equally as important, if not more important, to have a firm that understands premium finance and that goes through annual servicing and understands what to do and how to pivot. There's all kinds of things that you could use cash values to potentially pay down the note for a period of time, because my loan interest rate on my policy loan is going to be lower than my loan interest rate with the bank. There's lots of different things that you can do, but you can only do them if you have the experience, but more importantly, the staff and resources to service these strategies over an extended period of time. So we're going to go to polling question number 3. Please, again, pay attention to the polling question and answer it. But as we're going forward, again, thank you so much for spending time with us. Hopefully we've achieved all of these learning objectives. And let me extend a special thank you to Amanda Garcia and Wintrust for participating in this. They have been a great partner of ours, and to many others in the industry, and really are one of the most experienced and creative and easy to work with banks. There are others, but she's here, so we have to say the nicest things about her. But there are other fine lending institutions, but they are few and far between. I would say that there's only a handful, under 10, that are really good quality lenders, and probably under 6 that are really focused in this marketplace and will be there for the long term. So again, if you have any further questions, Please feel free to go ahead and, but we're right at the end of our time. We thought we were going to be done early. Boy, were we wrong. But uh, please feel free to ask any additional questions. And then again, you'll get a copy of this presentation and also a video recording that you can share with your colleagues if there was somebody that you think might enjoy this or that would learn from it. But feel free to contact Kim or myself or Amanda if you have any questions whatsoever, if you've got a client scenario that you'd like to brainstorm. Thank you again for joining WealthPoint's WP90X. We look forward to seeing you next time. And until then, have a very happy holidays and hopefully a happy and fruitful new year.